Thank you very much. Well, I guess I'll kick off, starting off with Tyler's remarks, because they reminded me of a Russian saying. The Russian saying that goes something a little like this: "The church is near, but the road is icy. The bar is far away, but we can walk carefully." And so I arrived yesterday night from Hong Kong. Grant arrived from Singapore, and I think you'll agree that's pretty far away. And I think this distance is a testimony to the respect, the friendship, the admiration that Grant and I have for Dave, for Tyler, for Jeff, for Nick, and for everyone at Evergreen. It's a terrific, terrific team. It also is a testimony to the fact that Dave does not run a church and that there is some booze outside. Dave asked me to speak about China, speak about Japan, speak about what's happening in emerging markets, and to do it all fairly quickly. So I'm going to start off. It's actually, I was happy he asked me to talk about that, because it really goes to what I've been doing for most of my career. I imagine that a lot of you in your respective careers have probably met people who've managed to have pretty much just one idea and managed to have a whole career out of them. I'm pretty much that guy. I had a very simple idea in 2002. It was that China was developing fast, and that all we needed to do to make money was just front-run the Chinese. That whatever the Chinese were going to buy, you needed to buy it first. And with that idea, you could build yourself a very diversified portfolio. You could buy real estate in Vancouver and in Hong Kong. You could buy stock in Porsche or LVMH. You could buy Bordeaux wine. You could buy Chinese modern art. It didn't matter. You could buy oil, copper, gold. If the Chinese wanted it, you needed to get there first. And this corresponded to two very important economic realities. The first economic reality was that over the course of the past 10 years, China's labor force grew by 200 million people. Put things in perspective, there's 158 million workers in the US today. So over the course of 10 years, China added more than an entire US labor force. The second structural factor in China was that over the course of 10 years, you had a massive expansion in balance sheets. And I would say expansion in balance sheets from the top down, from the central government to the provincial governments to the municipal governments to the state-owned enterprises, private enterprises, and individual. Everybody expanded their balance sheets. Now, frankly speaking, managing money doesn't need to be very complicated. You know, all we have to do is surf credit waves. When you see bank balance sheets expand, usually good things happen. When you see bank balance sheets contract, usually bad things happen. Which brings me to China today. If the past 10 years the story was front-running the Chinese, that trend is now over. The labor force in China is no longer expanding. It's now flatlining, and it starts shrinking in 2016. The balance sheets in China are no longer expanding. The balance sheets have been shrinking, and this is very much a government policy that, if you just spend 2 minutes listening to the government, is clear as day. So, as an investor, I'm confronting the somewhat challenging position of having to come up with a new idea, having milked this first one for all it was worth. And I'm not, you know, perhaps I won't be successful in this transition, but let me start off with a potential idea, because I think it is an important one. And that is that one of the most important macro changes that our world is going through today is the improvement in the US trade balance. On your chart here, you've got the trade balance in the US, blue line, used to be 6% of GDP, trade deficit, now 3% of GDP. The black line is ex-oil, and the red line is ex-oil and ex-China. Why does this matter? It matters because the US dollar is the world's reserve currency. And so when Korea wants to trade with Australia, they both need US dollars to trade with one another. When South Africa wants to trade with Brazil, these two countries need US dollars. And how do these countries get US dollars? They get dollars through the trade deficit. Every year, the US sends abroad $300, $400, $500, $600, $700 billion that allows to grease the wheels of global trade, allows Finland to trade with Taiwan and South Korea to trade with Indonesia. But look at what's happened in the past few years. Thanks in part to the shale gas revolution. Thanks in part to the manufacturing renaissance in the US is now sending fewer and fewer dollars abroad. And what does that mean for the guys on the other side? Well, it means, as we're now seeing in emerging markets everywhere, that all of a sudden, the dollars you used to get easily for decades, all of a sudden are scarce. All of a sudden, you can't get your hands on the dollars you need to trade. And so your central bank reserves start to shrink. And the blue line here is very simply, the red line, sorry, very simply is a piece of data that's published by the Fed every Friday, and it's reserves held at the Fed for foreign central banks. And that's the year-on-year percent change. And what you see is each time reserves start to shrink, whoever runs current account deficit or whoever is extremely leveraged goes bust. And sure enough, right on cue this year, we have reserves start to shrink in April. And right on cue, emerging markets hit the skids starting in the summer. Now, which brings me to today. Today you have a number of emerging markets that have been selling off aggressively. Turkey, South Africa, Brazil, Argentina, Venezuela, Ukraine, Egypt, you name it. A lot of emerging markets hitting the skids. Now, historically, when emerging markets hit the skids throughout the 80s and 90s, what would happen was the US consumer would expand his balance sheet and import more from the rest of the world and export dollars, which would allow the emerging markets to stabilize. Today, what you're seeing is the markets telling countries like Turkey, like Ukraine, like South Africa, that are running current account deficits of more than 5% of GDP, the markets are telling these guys, you have to adjust and move back into a surplus. The problem, of course, is that trade is a zero-sum game. If Turkey needs to move from -7% of GDP to zero, it needs to do it against somebody else. Which brings me to the first question I would ask the audience is, who do we think emerging markets are going to adjust against? Historically, it would have been the US consumer. But today, partly because of Fed policy that keeps the US dollar undervalued, partly because of the shale gas revolution, partly because of the manufacturing renaissance, the US trade deficit continues to shrink. So it's unlikely that the emerging markets can adjust against the US. Maybe they can adjust against the EU. And if you believe that, I have a bridge to sell you. Maybe they can adjust against China. This is what we witnessed in 2008. China in 2008 stepped up to the plate and said, you know what? I'll have a big stimulus bill. I'll move my current account surplus from 6% of GDP down to 1% of GDP, and I'll leverage up. Today, if you listen to the Chinese leadership, they're very clear about this. This isn't going to happen again. Which leaves you with the question, who out there is big enough for these emerging markets that are today in trouble to adjust? And I'm going to propose two possible options as to how this we go back into a positive equilibrium from a negative equilibrium where basically countries are just pushed into recession. The first positive solution is that emerging market countries start to move away from trading in US dollars and instead adopt a new currency. And here the new currency is obvious. The potential choice is the renminbi. Few people realize this, but over the past 3 years, the renminbi has actually been the world's strongest currency. And it's been the strongest currency and the best performing bond market. If you look at this summer, when every bond market was collapsing, Chinese offshore bonds that anybody in this room can buy, actually sailed right through. Last year, you could make, by taking not very aggressive risk, you could make 8, 9% on RMB bonds with about a 2.5% volatility. Now, anybody who's been in the markets long enough knows that these kinds of 8, 9% returns with 2.5% volatility, that's just not natural. It just doesn't come about. That's an obvious direct consequence of the market being manipulated. And being manipulated by who? Being manipulated by China. Now, why would China manipulate its bond market so that everybody in this room can have nice, stable returns? Is it out of the goodness of their hearts? No, believe it or not. It's because China is very keen to promote the RMB as a strong, stable currency, and the RMB bond market as a natural store of wealth for emerging markets to keep reserves in, and hereby moved its trade away from US dollars into renminbi. And China is being successful at it. In just 3 years, China has moved from 0% of its trade denominated in renminbi to 20% of its trade denominated in renminbi. Now, why would China do that? The first reason is, of course, the lesson of 2008. In 2008, China's exports all of a sudden moved from a 25% annual growth to a minus 25% growth. And so China turned to Indonesia, Korea, Thailand and said, why did you guys cancel orders? To which Korea responded, when Lehman went bust, trade finance froze, we couldn't get our hands on US dollars, we couldn't trade with you. Without dollars, we can't trade. So China says, this is really silly. Because American banks have been badly managed and badly regulated, all of a sudden, you and I can trade with each other. You know, why are we stuck in this ménage à trois thing with the American bank in between us? We're not even French. Let's have a committed relationship. Let's have a committed relationship and trade in renminbi. To which more and more countries are, of course, saying yes. Now, the other reason China is doing that is because it allows China to move up the value chain in terms of its exports. When we think of Chinese exports, we tend to think the stuff we buy at Walmart, the cotton underwear, the toys for the kids at Christmas, and whatever else. Increasingly, China, when you talk to the Chinese Ministry of Commerce, they tell you, our growth for the next 10 years will be selling telecom switches to India, earth-moving equipment to Indonesia, and oil rigs to Russia. And when you move into that business, you need to provide financing for your clients. Hence the need to create a deep capital market. Which brings me to China's single biggest comparative advantage that nobody thinks of. If I ask you, what's China's big comparative advantage? You're probably going to say cheap labor or having a very large economy. Forget it. Chinese labor isn't that cheap anymore. China's big comparative advantage is that alone amongst any emerging market, it has a deep liquid financial center that people can trust. And here China was amazingly lucky because the Brits built it for them. And the Brits are pretty good at building financial centers. So the Brits built Hong Kong, give back Hong Kong to China in '97, and China does nothing with it for 12 years until the financial crisis hits, and China realizes we have to use this to break our dependency on the US dollar. And this is what is happening today. This is what's happening in front of our very eyes. And it's a transition somewhat similar to what Europe had in the 1970s, where Europe moved away from its dependency on the dollar and moved to the Deutschmark, which made assets in Europe much more interesting for many reasons. It made assets more interesting because all of a sudden, you weren't dependent on the US financial cycle anymore. Look at it this way. The world of yesterday was an Indonesian coal mine buying a Caterpillar machine financed by Citibank. And if ever something bad happened in the US, Citibank would tell the Indonesian coal mine, give me my money back. And activity in Indonesia would collapse. The world of tomorrow is a world where the Indonesian coal mine buys a Longhe machinery financed by an Indonesian bank that goes and issues an RMB bond in Hong Kong bought by Asian savers everywhere. In other words, Asian savings financing Asian growth. And in so doing, Asia starts to have more of its own independent cycle, gets a lower cost of capital, and a more stable source of capital. And that means a re-rating of assets. This is why, as I look at today, the sell-off across Asia, but at the same time, I look at the financial changes that are happening in the very financial infrastructure of our region, I can't help but think that this is a tremendous opportunity. Indeed, there is always what you see and what you don't see. What people see today is what I started with, the slowdown in China. What people see today is the challenges that emerging markets face. What people don't see is how these challenges are being met. What people don't see is the cheap valuations that are prevalent on most Asian assets today. And what people don't see is the opportunity set for the region is being amplified dramatically as the dependency on the Western world continues to diminish. And on this, I'll pass on to Grant. Thank you very much.